Hello, welcome to another Wise Guys tutoring video in the financial accounting series. And in this one, we're going to look at closing journal entries. Okay, so first, the closing process. Well, the first thing we want to close is our revenue accounts. Second thing we want to close is our expenses. So we close both revenues and expenses to an account called the income summary. So these get closed to the income summary. And the third step is to close the income summary. And we close the income summary to capital. And then the final step is to close the withdrawals. And this also goes to capital. So that's our 4 steps. REID. Revenues, expenses get closed to the income summary gets closed to capital, and then withdrawals gets closed to capital. Okay, so prepare the necessary closing entries from the following list of accounts and calculate J. Burns capital for December 31st, 2012. So here's our advertising expense, depreciation expense, fees earned. Well, earned is our revenue. Here's his beginning capital. So we'll worry about that when we do figure out the balance at the end of the year. Here's the withdrawals. Here's insurance expense, interest expense, interest revenue, rent expense, salaries expense, supplies expense, telephone expense, total assets, total liabilities. Okay, these do not get closed. So we have 2 revenue accounts. We've got consulting fees earned, and we had interest revenue. So those are going to get closed first. So now, the natural balance of a revenue is a credit balance. So to close, we must do the opposite. So then the opposite means we debit. Okay, so that's how we're going to close the revenue accounts. So there's our 2 revenue accounts, consulting fees earned and interest revenue. Start with the date, December 31st. So then these are credits, so we must close them with the debits. So we're going to debit consulting fees earned and interest revenue. And they get closed to the income summary. So 217,900 and 1,500. Bring in our calculator. So 217,900 plus 1,500 gives us 219,400. Okay, so that's step 1, closing the revenues. So consulting fees, interest revenue. Step 1, done. Step 2, close the expenses. So we've got depreciation expense, insurance expense, interest expense, rent expense, salaries expense, supplies expense, telephone expense. So these are all our expenses. So there we go. I've just quickly listed them for us. So now, expenses have debit balances. And to close, we do the opposite. So that means we must credit the expenses. And these get closed to the income summary. So that means that's what I'm going to debit first, income summary. And then we're just going to list all of these off. So then we've got advertising expense, depreciation expense, and that's for the building, insurance expense, interest expense, rent expense, salaries, supplies expense, and telephone expense. Okay, so 2,500 for advertising, 1,500 for depreciation, 2,200 for insurance, 1,200 for interest, 7,700 for rent, 85,000 for salaries, 900 for supplies, and 400 for telephones. So now we just add those all up, and then we debit the income summary for the total. So then the total is 101,400. Okay, so that's step 2, closing the expenses. So there you go, both get closed to the income summary. So now step 3 is to close the income summary to the capital. However, we have to be careful here because we've used the income summary in 2 of our journal entries. We use the income summary as a credit here and a debit here. So what we do, or what I would do, is I would actually draw a T account for income summary. And then I would post these 2 amounts. So this is my debit for the income summary. So 101,400. And this was my credit, 219,400. So what we need to do here is we need to find out what type of balance does income summary have, because we posted the revenues and expenses. So the revenues went over here on the credit side and the expenses went over here on the debit side. So now if my revenues are bigger, I end up with a credit balance, which would mean I have a net income. If my expenses are bigger, I end up with a balance on the debit side, which means I end up with a net loss. Well, our revenues are bigger, but by how much? So we subtract the 219,400 minus the 101,400, and we find that we have a credit balance of 118,000. So this means we have a net income. Okay, so we have a credit balance, so we have a net income. So to close the income summary, well, we continue to do the opposite. So since we have a net income or a credit balance, that means we have to debit to close. So we debit income summary, and the income summary gets closed to the capital account. So the capital account is J. Burns Capital. And then we just credit it for the same amount. So there we go. We've closed the income summary to the capital. So the last step is to close the withdrawals. So here's the withdrawals. So Burns withdrew $35,000. So that's our step 4 now. And there we go. J. Burns Capital, our withdrawals, $35,000. Now, withdrawals have a debit balance. So to close, we must credit. So that means capital has to be the debit. And then 35,000. All right, so there's step 4. Now the last thing they wanted us to do was calculate J. Burns capital for December 31st. Now this is the beginning capital, 110,000. Capital should have a credit balance. So I'm going to put that on the credit side. Well, we can just quickly post this one since it's on the same page. So this is a debit to capital. So I'm under capital. I'm going to put it on the debit side. And then if we just go back to the closing of the income summary, we had credited J. Burns capital for 118,000. So I'm going to post that on the credit side. So we just bring the $35,000 down on the debit, and we add the two credits together. So 110,000 plus 118,000. So this is 228. So now we subtract the 35,000. And so then the new capital is 193,000. So this is the new capital balance for December 31st. All right. So let's just do a quick review. The 4 steps to closings are: step 1, you want to close the revenue accounts first. So then to close them, we debit the revenue and we credited the income summary. Step 2 is we close all the expenses. So the expenses are debit balances. So to close them, we have to credit them. So the debit is the income summary and the credit is the expenses. For the closing of the income summary account, the 3rd step, this is dependent upon if we have a net income or a net loss. In our question that we did, we had a net income. So if we have a net income, we debit the income summary and we credit capital. But if we had a net loss, then the entry would have to be the other way. We'd actually have to debit capital and credit the income summary. So when you do step 3 is dependent upon what you did in step 1 and step 2. If the revenues are bigger, we end up with a net income. So then we debit income summary and we credit capital. But if expenses are bigger, then we end up with a net loss, which means we have to debit capital and credit the income summary. So of the 4 entries, this is the only one that could go 2 ways. It depends on, do we have a net income or do we have a net loss? And then finally, to close the withdrawals account, we debit the capital and we credit the withdrawals. And then REID, revenues, expenses, income summary, and D stands for drawings, which just means withdrawals. All right, so this has been a Wise Guys tutoring video for the financial accounting videos. Thank you for watching and have a great day.